Yes, so therefore, first of all, you have said we need to come up with a group structure, and then from there, we go through the additional information, we see what we are told, we do any working which is necessary, and finally, we answer our question. So therefore, let's, first of all, we have the group structure here. The group structure. Structure. So where do we get information about the group structure? The information about the group structure, we have it in the first paragraph. So let's go back to the first paragraph of that question, and we are told on 1st of April 2021, Riziki Limited acquired 75% of the equity shares of the company which is called Sarama Limited. So we are told the company which is called Riziki Limited acquired 75% of the equity shares of the company called Sarama Limited, and that took place on 1st of April 2021. 1st of April 2021. So basically what that means is that this now will be a parent, and this is what is a subsidiary. But if you go also to the requirement Roman 1, you'll be able to see there is something they require to compute there, the value of investment in Amua. So meaning that we also have another company which is acquired by Riziki, and we have that information in note number 4. Can we go to the additional information number 4? In number 4, we are told on 1st of April 2021, on 1st of April 2021, Riziki Limited also acquired 30% equity interest in the company which is called Amua Limited. So meaning that this company here, Riziki Limited, has also invested in the company which is called Amua Limited, and we are told Riziki Limited acquired 30% equity interest. It acquired 30% of the equity shares of Amua Limited. On which date? On 1st of April 2021. So essentially, you can see that the two companies here, Amua and also, or basically the investment by Riziki Limited in Sarama and also Amua, that investment took place on the same date, 1st April 2021. So that is basically our group structure, and that is just a sketch. I think we can have now the final group structure here. We have Riziki Limited, which first of all, you're told acquired 75% of the equity shares of the company which is called what? Sarama Limited. And then Riziki Limited equally here, we are told it also acquired 30% of equity shares of the company which is called Amua Limited on 1st of April 2021. 1st of April 2021, meaning that Riziki Limited, now this will be our parent, this will be our subsidiary, and then this company which is called Amua, that will be an associate, because we said anytime the parent company has acquired shares which lies between 20% to 49%, that company is actually deemed to be an associate. The parent company is said to have or is said to acquire significant influence. So the parent company is in a position to influence the operating and financial decisions which will be made by that company, in which case we said in terms of how we account for associate, we account for associate using what FR as equity method. So when preparing the consolidated income statement, we don't include the revenue and expenses of associate. We only include something called the group share of the associate profit after tax. And when preparing the consolidated statement of financial position, we don't include the asset and liabilities of associate, rather we include something called investment in associate. And actually, that is what we are required to compute in Roman 1. But Sarama Limited is a subsidiary, meaning that when preparing our consolidated SOFP, as required in Roman 3, we are going to add similar items of asset and liabilities of the parent, those of Sarama. It is also important here, basically, to note when this acquisition, or it is important to determine whether this acquisition took place in course of the year or basically before the start of the year. And therefore, if you go to the requirement down there, specifically in Roman 3, you'll be able to see that we are required to prepare a consolidated statement of financial position for the year which ended 31st of March 2022. Basically, what that means that the financial of this group is ending on 31st of March 2022, meaning that the next financial will start on 1st of April, or basically the financial of this group start on 1st of April, meaning that this year, which ended on 31st March 2022, it started on 1st of April 2022. That is when the year started. And therefore, you can see this Sarama, it was acquired on 1st of April 2021, just like this associate. Both the subsidiary and associate, we can say, they were acquired exactly at the start of the year. At the start of what? Of the year. We said that information is very important to you when doing your consolidation. You determine when these companies were acquired. And basically, you can see both of them, both the subsidiary and associate were acquired at the start of the financial year. At the start of the financial year. That is basically quite important. So, and I think having that now, you now know how to do your consolidation. How we are going to prepare a consolidated statement of financial position. We have said we are going to add similar items of assets and liabilities of the parent and those of the subsidiary, that is Sarama. But as far as this company is concerned, Amua, we are not going to include its assets and liabilities in the balance sheet. In fact, in this question, you can see we are only given the statement of financial position of which company, Riziki and Sarama. We are not even given the assets and liabilities of Amua because we don't need them. We don't include them in the consolidated statement of financial position. But before we do that, let's just go through the additional information. We see what we are told, and we see whether any working is required. So in addition information number one, let's go there. We are told that on first, we are told the fair value of Sarama Limited net asset approximated their carrying amount with an exception of a special piece of equipment which had a fair value of shillings 120 million in excess of its carrying amount. The equipment had 10 years remaining useful life on 1st April 2021. So basically what we are told is that on the date of acquisition, this company, that is Sarama Limited or a subsidiary, revalued its asset. This is basically what we refer as a fair value adjustment. We say it is always a normal practice that whenever a subsidiary is to be acquired by the parent, the subsidiary company revalue its asset in readiness of the acquisition. And what we say is that once that company revalue its asset, basically the subsidiary do not account for the revaluation. As a result of that, we say we make two adjustments. One, we make an adjustment with respect to the revaluation gain or loss. And two, we also have to compute the depreciation other charge. So therefore, what we need to do here is basically to deal with that okay, sorry for that small technical hitch. So therefore what you have said is that what you're given in note number one is the revaluation of asset by which company? By Sarama. So therefore you have said we have to determine two things, whether there was a revaluation gain or loss, and also we determine the depreciation undercharge or overcharge. So therefore that exercise through which this company revalue its asset, we refer to it as the fair value adjustment. This fair value adjustment, it is very, very important to note it is by Sarama Limited. And what we say is that when this company revalue its asset, it is obvious that that company do not account for that revaluation. As a result of that, we make two adjustments. The first adjustment is known as the revaluation adjustment, of which this revaluation adjustment is an adjustment in respect to any revaluation gain or loss arising from the revaluation of asset by Sarama. So what we are told in number one is that the fair value of Sarama Limited net asset were equal to their carrying amount with an exception of a specialized piece of equipment which had a fair value of shillings 120 million in excess of the carrying amount. In other terms, what that means is that the fair value of that item of equipment was more than the carrying amount. Carrying amount, in other terms, he said, is the net book value with how much? With 120. So the fair value was more than the carrying amount. So meaning that this 120 million here, this is automatically a revaluation gain. We said anytime we are told fair value is more than this, that is a revaluation gain. But also what you need to note is that that figure is 120 million, but all the figures in the statement of financial position are given in thousands of shillings. So therefore, what you're going to do, we're going to work with all our figures in thousands of shillings. In thousands of what? Shillings. So therefore, this amount here, we have said is a revaluation gain. Is a revaluation what? Gain. This revaluation gain, we have said, it was not accounted for by this company. This company revalued its asset upward with an amount of 120, but never accounted for that gain. So therefore, we said, when doing our consolidation, when we're preparing our consolidated statement of financial position, one, this particular amount of 120 here should be added to the group PPE, to the group property, plant and equipment. And number two, we say that this is treated as a pre-acquisition revaluation reserve. Is a pre-acquisition revaluation reserve. And remember, you say that that amount, therefore, will be used when computing the goodwill in respect to acquisition of Sarama. When computing the goodwill of Sarama, specifically when determining the fair value of Sarama Limited net asset at the date of acquisition, and this will be one of the components, because when computing the fair value of Sarama Limited net asset at the date of acquisition, we said we take Sarama Limited ordinary share capital plus or pre-acquisition reserve. So therefore, that is the first adjustment which will be made as far as the revaluation of asset by Sarama Limited is concerned. Number two, we also make the other adjustment, which is called the depreciation adjustment. Specifically here, what we need to do is to compute something called depreciation other charge. We say that anytime you are told a subsidiary revalued its asset upward, never accounted for that, it means that that company has been undercharging depreciation. And we say that this depreciation undercharge is ordinarily computed from the date of acquisition to the date of consolidation. We know that Sarama Limited was acquired exactly at the start of the current year. Exactly at the start of the current what? Year. So therefore, this particular depreciation undercharge, we are going to compute it from 1st of April 2021 to the date of consolidation, which is 31st of March 2022. So meaning that we are computing depreciation undercharge here for 1 year only. For one what? Year. For 1 year. So therefore, how do we compute that depreciation undercharge by Sarama Limited? We take the evaluation gain fair 120, and then if you go back to the information we have in number one, we are told that the equipment had 10 years remaining useful life. So the reason why given that information is to help us in terms of computing depreciation. And we said if we are given the remaining useful life of an asset, then the depreciation should always computed based on or using straight line method. So meaning that we take our gain of 120,000 and then we divide that with 10, which are the remaining useful life 10 years. In our case, we get a depreciation undercharge of 12,000. Now, this particular depreciation undercharge of 12,000, which is by Sarama, one, we said it should be deducted from the group property, plant and equipment, and two, we also less it from the retained earnings of Sarama. We less it from the group retained earnings, and then we also less it from the retained earnings of what? Sarama. That is the adjustment as far as that depreciation undercharge is concerned. But also remember, we say that if, for example, we were preparing the consolidated income statement, this particular amount here, we add it to the group cost of sales. We add it to the group cost of sales. Okay, so let's move now to note number 2. And you're told that it is the group policy to value the non-controlling interest at fair value at the date of acquisition. Definitely we say that if you come across that information, that it is the policy of the group to value or to measure NCI at fair value, that means that when computing goodwill, we compute the goodwill using the full goodwill method. The full goodwill what? Method. That is what is important to note. And we are told the fair value of the non-controlling interest in Salama Limited on 1st April 2022 was estimated at 144 million. All this information, we are going to use it in computing goodwill, plus now some of the information we have in number 1. So, but we compute the goodwill as the last item. Then, in number 3, let's go to note number 3. In number 3, we are told that during the year which ended 31st March 2022, that is now the current year, Salama Limited sold goods to Riziki Limited for shilling 64 million. So Salama Limited, which is a subsidiary, sold some goods now to Riziki. So this what we refer as intra-group trading or intra-group sales. We say, if for example, we are preparing now the consolidated income statement, that amount of 64 should be deducted from the group sales and the group cost of sales. But here, we are not preparing the consolidated. We are not required to prepare consolidated income statement. So meaning that our interest here is to determine whether there was any unrealized profit. And that's why we are told that company was, or it earned a gross profit margin of 25% on sales. And then you're told Riziki Limited still held shillings 48 million worth of these goods in the inventory as at 31st of March 2022. Now, the reason why given that information about the goods not yet sold is for us to be able to compute what we refer as the unrealized profit on inventory. Unrealized profit on inventory. And this unrealized profit, we said, it is also very important to notice by which company. This unrealized profit is always by the selling company. The selling company is the company which sold those goods. We are told in note 3, the company which made sales was Salama. So therefore, this unrealized profit is by the selling company, which is Salama Limited. How do we compute this unrealized profit? To compute the unrealized profit, we said we take the unsold goods. We take the unsold goods. We multiply that with the gross profit margin. That is the general formula for computing the unrealized profit. So what you're told is that the goods now which were sold by Salama to Riziki, they had a value of 64 million. But in the other sentence, we are told the goods still, Riziki Limited still held shillings 48 million worth of these goods. So meaning the goods not yet sold at the end of the year, they had a value of 48 million. Remember, we say that we use all our figures, we work with all our figures in thousands of shillings. So 48 million in thousands of shillings, it would be 48,000. And then we multiply that with the gross profit margin, which is given as 25%. 25%. So this will give us what? Give me that figure there. The gross profit, the unrealized profit there. The unrealized profit here is 12,000. Is 12 what? 12,000. 12,000. 12,000. So how do we deal with this particular amount of unrealized profit? How do we deal with this amount of unrealized profit? Now, this unrealized profit, one, we said we less it from the group inventory. We less it from the group inventory. And two, we also less it from the retained earnings of which company? The retained earnings of Salama Limited. We less it from the GI, group inventory. Group inventory, and also we less it from the retained earnings of Salama. But equally, we said, if, for example, we were preparing the consolidated income statement, this unrealized profit, we said, should be added to the group cost of sales. If you are doing we are preparing the consolidated income statement, we add that to the group cost of sales, but we are not required to do that. So then what now we need to do, I think we need to go to the other point there. To the other point, we see what we are told. Actually, the same point number 3, the last sentence we are told. We are told what? We are told the last sentence of note 3, Riziki Limited. Okay, not that point. The last one, Salama Limited still had the full invoice, the full invoice value of sharing 64 million in its receivables as at 31st of March 2022. However, Riziki Limited trade payables only showed sharing 34 million as it made a payment of 30 million on 31st March 2022. Now, that information which you are given there is regarding what you refer as the amount of intercompany debt. Amount of intercompany debt. Remember here, what we know is that Salama Limited sold some goods to Riziki. It is obvious that Riziki here was supposed to pay Salama Limited some amount of money. And remember the goods now which were sold by Salama to Riziki, they had a value of 64 million. So when Salama Limited sold those goods to Riziki, it sent an invoice of 64 million. So meaning that in the books of accounts of this company, or this company here, Riziki, owed or was supposed to pay Salama 64 million. 64 what? Million. So that amount which now this company was supposed to pay, automatically it appeared part of its payables, part of its trade payables, whereas this company in its books of account, it accounted for that 64 million as part of its receivables. As part of what? Receivables. But what are we told in that last sentence of note number 3? We are told Salama Limited still held the full invoice of 64 million, which was sent to it by Salama. In it the full invoice in its receivables. Okay, basically what you are told is that Salama Limited in its receivables, it held the full invoice of 64 million. This is the amount Salama Limited was supposed to be paid by Riziki at the end of the year, but you are told the trade payables of our parent company here now, that is Riziki, showed only 34 million because it had made a payment of what? 30 million. Basically, this is quite simple. We have said that Salama Limited sold some goods to Riziki. It is obvious that Riziki Limited here was supposed to pay Salama an amount of 64 million. So this amount of 64 million, in the books of account of this company, it appeared there as part of trade payables, 64 million. But in the books of account of this, that appeared as trade receivables. Trade receivables of this company included 64 million, which it was supposed to be paid by what? Riziki. But we are told at the end of the year, the books of account of Riziki, or what was included in the payables of Riziki, was not 64, but rather it was 34, because this company here had made a payment of 30 million at the end of the year. And automatically this payment, because it was made at the end of the year, that payment had not been accounted for by this company. That's why we are told in the receivables of this company, what was included in its receivables was 64 million, but in the books of account of this, what appeared at the payables as the amount it was supposed to pay to Salama was 34, due to that payment which was made of 30. So first of all, we said that this payment which was made at the end of the year, but not yet accounted for this company, we refer to that as cash in transit. Cash in what? Transit. Basically, what that means is that when preparing our consolidated statement of financial position, so what we are going to raise from the group payables is what appeared under the payables of the parent. Under the payables of the parent, the amount appeared there as the amount it was supposed to pay to the subsidiary was 34 million. So therefore, this is what you're going to raise from the group payables. And then from the group trade receivables, group trade receivables, we are going to raise 64 million because you can see the receivables of Sarama still included 64 million as the amount it was supposed to be paid by Riziki. And then this amount of 30,000, which was the payment made at the end of the year, we refer to that as cash in transit, CIT. Now, this cash in transit, this will be added to the group cash and bank balance. So therefore, I've said this is what you're going to raise from the group payables. This is what you're going to raise from the group receivables. And then this one, we added to the group cash and bank what balance. This is an amount of intercompany debt, which is basically not the same, which was not equal. And therefore, that's how we deal with that, or basically how we are going to do to deal with that particular what, that particular amount of intercompany debt. So we are through with that. Let's move to note number 4. In note number 4, this is where we're given information about acquisition of our associate Amua. We are told on 1st April 2021, Riziki Limited also acquired 30% equity interest in Amua for shilling 65 million in cash, 65 million, which was paid in cash. So then you are told Amua Limited sustained heavy losses over the last few years, and Riziki Limited hoped it would turn it around through a significant influence over Amua. So we are told in the year which ended 31st March 2022, Amua Limited made a loss of shillings 150 million. So meaning that during the current year, this company made a loss, not a profit, a loss of 150 million. So now this particular information which we have in that point number 4 is basically what you're going to use in tackling Roman 1 of that question, computing what if as investment in Amua. Remember, we say that when preparing our consolidated SOFP, consolidated balance sheet, we don't include assets and liabilities of this company, but rather we include something called investment in associate. And basically, I showed you how we compute that amount. So that information we have there is what you're going to use in answering Roman 1. Then in Roman 5, we are told the impairment test performed on 31st of March 2022 revealed that investment in Amua had been impaired by 5 million, shillings 5 million, due to sustained trading losses. However, no impairment loss was required in respect of the goodwill arising on acquisition of what? Sarama Limited. So mean that the goodwill in respect to acquisition of this company had not what? Impaired, but in investment in associate had impaired with 5 what? Million. And I think now having that, we can proceed and compute the goodwill. Although I think we don't need to compute the goodwill, because if you go to that question, you'll be able to see Roman 2 actually required to compute the goodwill. So instead of having the goodwill as our last working here, we are going to do it as, or we are going to compute that goodwill as required in Roman 2. Sasa? Yes, because generally we said we should have the last working as the computation of goodwill. We will not compute that, but basically we are going to compute it when answering Roman 2. So therefore, let's now go straight to Roman 1 of that question, whereby we are required to compute what is the value of investment in Amua. In other terms, what the examiner here was requiring, is you compute what you refer as investment in associate. Our associate company is the company which is called Amua. The company which is called what? Amua Limited. That is what is required there. That is what is required there. Now, who can remind us how we compute this investment in associate? How do we compute this investment in associate? Who can remind us? Who can remind us how we compute the investment in associate? Yes, someone to unmute and tell us how we compute this one. How do we compute this investment in associate? Yes, how do we compute investment in associate? Someone to unmute and tell us how we compute this. This is something we discussed. And I shared the note in respect to this. I hope you have gone through the notes. Yes, how do we compute this one? Yes, how do we compute the investment in associate? Yes, you even have the notes. Can you refer that to your note? You tell me how we compute this. Hii ni kitu tulisoma kwa class and equally I shared the notes with you. So I expect at least you have gone through the notes. You can be able to remember what we covered or what we said. Okay. So I think we just then proceed. We compute this one. They say participating in class is good. Now, if I ask a question and all of you're not speaking, how do we proceed? How do we proceed? How do you proceed without you not answering the question I'm asking? This is something we discuss in class. You have the note with you. So anyway, let's just continue. So to compute the investment in associate, we said we take the cost of investment. The cost of investment. The cost of investment is what the parent company paid in acquiring shares of Amua. We have that in note number 4, whereby we are told on 1st April 2021, Miziki Limited also acquired 30% equity interest in Amua for shilling 65 million. So the amount which was paid by the parent company in acquiring shares of Amua, 65 million. That's what we have here. And then to this, we said we add the group share. The group share of post acquisition retained earnings. But in this question here, this subsidiary, we are told it reported a loss. It reported a loss. So therefore, what you're going to do, we are not going to take into account we are not going to add the group share of post-acquisition retained earnings. We are going to add the group share of the post-acquisition loss. Post-acquisition loss. And basically the post-acquisition loss is the loss which was reported by this company during the current year. Remember that the associate was acquired exactly at the start of the year. So therefore, the loss it's reported during the current year is a post-acquisition loss. A post-acquisition loss is the loss of the associate after it was acquired by the parent. That information, we have it in note number 4. The loss which was reported by Amua, in note number 4, the last sentence was 150 million. Was 150 million. Now we are interested with the group share of that. The group share of that will be 30%. We multiply that with the parent company shareholding here, which will give us 45,000. And because it's a loss, we don't add it, we less it because it's a loss. But if it was a profit, we add it. And then to this, we also less any impairment loss in respect to the goodwill of associate. So we are given that information in note number 5, whereby we are told impairment at a test performed on 31st of March 2022 revealed that the investment in Amua had impaired with 5 million. So the investment in Amua had impaired with what? 5 million. So whatever you get there is what you refer as investment in associate. Investment in associates, this would be 65 minus 50. That will give us 15. This is what you transfer to the consolidated statement of financial position as far as the associate is concerned. That's what was required in Roman 1. In Roman 2 of the question, we are required to compute the goodwill on acquisition of Sarama Limited. The goodwill on acquisition of Sarama Limited. Now remember, there is some information which are given in note number 2, whereby we are told it is the group policy to value and controlling interest at fair value. At fair value, basically what that means that when computing the goodwill here, we compute the goodwill using the full goodwill method. So how do we compute this goodwill on acquisition? First of all, we take into account the cost of investment. Now, this cost of investment, if you go back to the first paragraph of that question, you'll be able to see the cost of investment comprised of two components. As per the first paragraph of that question, you're told on 1st April 2022, Riziki Limited acquired 75% of the equity shares in the company called Riziki Limited when the retained earnings of Sarama Limited stood at 234 million. And then you're told the acquisition consideration. This is the consideration paid, consisted of cash, which amounted to 510, and a share exchange. So meaning that this cost of investment comprised of cash consideration of what? Of 510 million. And also part of this purchase consideration was paid through share exchange. Was paid through what? Share exchange. Was paid through share exchange. So what we need to do here is to determine this purchase consideration paid through share exchange. Through share exchange, we said to compute that we take, or first of all, we determine number of ordinary shares issued by the parent company to pay the purchase consideration times the market price per share. So we have that information in, we go back to the first paragraph, sentence 2, where we are told the acquisition consideration consisted of cash amounting to 510 million and a share exchange of two shares for every 3 shares acquired. For every 3 shares which were acquired. So therefore, the first thing we need to do is to determine how many shares were acquired by Riziki in Sarama. So to do that, we need first of all to determine the shares issued by Sarama Limited. So how do we determine the shares issued by Sarama? We go to its balance sheet. In the balance sheet of Sarama, specifically under equity, its ordinary share capital was 300 million or 300,000. So this is the ordinary share capital of Sarama. So to get the shares issued by Sarama, we divide that with the par value per share. The par value per share is what we have after the word ordinary share capital. And after the word ordinary share capital, into bracket, we have shillings 10 par value. So therefore, the shares issued by Sarama, they had a par value of 10. So to determine the shares issued, you take its ordinary share capital, divide that with the par value. That will give us what? 30,000 shares. But in our case, what you're interested with are the shares acquired by Riziki in Sarama. So we know that Riziki Limited acquired 75% of those shares. 75% of those shares. So 75% of 30,000, this will give us 22,500. 22,500. These are the shares which were acquired by Riziki in Sarama. And you are told that Sarama Limited, not Sarama, but rather Riziki, was to pay part of the purchase consideration through share exchange. So we need to determine how many shares were issued by Riziki in paying the purchase consideration. So we take 2 times what? 22,500. We divide that with 3. We divide that with 3. Times 2 divided by 3. So which will give us 15,000. 15 what? 1,000. These are the shares now which were issued by the parent company in terms of paying the purchase consideration. So therefore, to determine purchase consideration paid through share exchange, we already have the shares issued, 15,000 here. So we need to multiply those shares with the fair value, with the market price per share. So that information, we also have it in paragraph 1. Sorry. So we are told in paragraph 1, there is a sentence there which start with I think the first paragraph, the second sentence from last. We are told the market value of Riziki Limited shares as at 1st April 2021 was shilling 16. So meaning that on the date of acquisition, the shares of Riziki Limited, they had a market price of what? 16. So therefore, what we need to do, we take the shares issued by the parent company times the market price per share. This will give us what? Will give us the purchase consideration paid through share exchange. 15,000 times 16. This will give us it will give us 240. So meaning that the purchase consideration paid through share exchange is what? Is 240. So now, because we are using the full goodwill method, to this cost of investment, under the full goodwill method, we add something called the NCI at fair value. NCI at fair value. NCI at fair value, we have that in which point? In note number 2. Is it note number 2? Yes. In note number 2, you're told it is a group policy to value non-controlling interest at fair value. At the date of acquisition, the fair value of the non-controlling interest in Sarama Limited on 1st April 2021 was 144 million. That is the NCI at fair value. So we need to include that there because we're using which method? The full goodwill method. So we add all this. This will give us 89. Then this will give us 894,000. So then to this, what we less is the fair value of net assets acquired. Fair value of net asset acquired. Fair value of net asset acquired. So this one, we say that, or basically to compute the subsidiary company, fair value of the net asset at the date of acquisition, we said we take its ordinary share capital plus all pre-acquisition reserves. So therefore, what we need to do, we need to take into account the ordinary share capital of this company, and then we add all pre-acquisition reserves. So let's go back to the balance sheet of Sarama, specifically where we have equity. So the ordinary share capital of Sarama Limited is 300,000. And then to this, what do we add? We add pre-acquisition reserves. Pre-acquisition reserves, these are the reserves Sarama Limited was having at the date of acquisition. And one of the pre-acquisition reserve is what we have in paragraph 1, the first sentence, where we are told on 1st April 2021, Sarama Limited acquired 75% of the equity shares in Sarama when the retained earnings of Sarama was what? Was 234. So that retained earnings on the date of acquisition is a pre-acquisition retained earnings. Retained earnings. I think that's what we have. And then if you go back to still the balance sheet of Salama Limited under equity, you'll be able to see that that company only, or what is appearing under equity is ordinary share capital and the retained earnings. The retained earnings, you take the retained earnings at the rate of acquisition. So, but equally we said if we had a share premium there, unless told otherwise share premium, you also treat it as a pre-acquisition reserve, you include it here. But also we have to remember that this company, that is Salama Limited, on the date of acquisition, it revalued its asset. It revalued its PP. And remember, as a result of that, we had there was this revaluation gain of 120, which we said is a pre-acquisition reserve. The reason why we treat that as a pre-acquisition reserve is because we use that here. When computing the goodwill, we treat it as a pre-acquisition revaluation reserve here. How much is that? Is 120. Is 120. So this company didn't have any other component of net asset. We get the total here. We get the total. We get the total. And because we are computing now the goodwill using the full goodwill method, we take 100% of that. We're using full goodwill method. But if you are using partial goodwill method, we just take 75% of this. But we're using full goodwill method. So we take 100% of that. So which will give us 654. So we less it from that figure. Which will give us 240. Now this 240 is what? Is the goodwill on acquisition. The goodwill on what? On acquisition. So therefore, the goodwill on acquisition in our case is what? Is 240. Is 240. So that is it. That what was required number 2 of that question. And I think having that now we can finalize by preparing what was required in number 3. The consolidated statement of financial position. So in this case, we use the name of the parent. The name of the parent is Riziki, but essentially we refer to this as Riziki Group. This is a consolidated statement of financial position as at 31st of March 2022. 31st of March 2022. So now here, what is important to remember is that when preparing that consolidated statement of financial position, we are only adding similar items of asset and liabilities, those of the parent and those of the subsidiary. We don't include the asset and liabilities of the associate there. What we include there as far as the associate is concerned is what we refer as investment in associate, and that is what you have included here. We say that this will be taken to a consolidated SOFP as a component of non-current asset. Yes, so therefore, that's why you can even see in this question, we don't have the asset and liabilities of Amua because we don't include asset and liabilities of associate here. So we just need to have a single column here. So we start with the non-current assets. Now for non-current asset, what do we have? We have the property, plant, and equipment. A property, plant, and equipment for Riziki is 1595, 300, and then those of Salama is 636, 400. Then to this we need to check whether we have any adjustment which is to be made to the PP. And here we have an adjustment. Remember, he said that anytime you are told that on the date of acquisition, the subsidiary had revalued the asset, or basically what it did, what referred as a fair value adjustment, then any revaluation gain will be added here, and also any depreciation under charge. That's why we say that this 120, we added to the group PPE. So we add to this, we add what? We add 120. And then we also have this depreciation under charge, which we said of 12, which we said we less from the group PP. So to this, we are also going to less what? We also less 12,000. So that is the only adjustment which will be made to the group PP. So you get the final figure there. So then we go to the other item. Below PP, what do we have? We have investment. We have investment. Now, the investment generally, this will include now what the parent company had invested in Salama and also Amua. So the investment which you're given, say, is only investment by Riziki. How much is that? 575,000. Now, this automatically include the amount Riziki Limited had invested in Salama and also Amua. So what we know is that when our parent company acquired the subsidiary, it paid a cash of 510, and also there was an amount which was paid through share exchange. Basically, we said this amount paid through share exchange was not accounted for. So what the parent company had accounted for is 510, and this 510 is part of this. So what we said that investment in a subsidiary should not be included here. What we include here is any goodwill arising, because that amount, this 510, we have used that in computing goodwill. So we can't include that amount here. So therefore, we list it here. And also we know that this company also invested in which company? In Amua. How much amount did the parent company pay? We have that amount here, which is 65. So that 65 still, we list it here. And actually, you can see that after deducting 510 and this one, that automatically will give us 0. That investment by the parent in subsidiary and also associate should not be included there. Sasa, yes. Then, do we have any other item of non-current asset? No. But there are two items which we already have here, which will be part of the non-current asset. One of it is this amount here, the investment in associate. Investment in associate, or basically investment in Amua Limited, which you have already computed here, the amount of 15,000, and also this goodwill. Remember that goodwill was not impaired. That goodwill of 240. That goodwill of what? 240. So those are some of the items, the two additional items we are going to have here. Then from there we proceed, we record what? Current asset. We proceed and record the current asset. Proceed and record the current assets. Now for the current asset, we have how many items there? We have three items. We have inventory. We have trade receivables. And then we also have something called a bank. So for inventories, we add those of the parent, 165,000, plus those of the subsidiary, 160. And then the only adjustment which we make now to this particular inventory is something called the unrealized profit. Unrealized what? A profit. So what basically we need to remember is that in our case, we had unrealized profit here, which we computed. Where do we have that unrealized profit? We have it in working, or basically, yes, in working number 3 here. Working number 3, whereby we said this unrealized profit of 12,000 will be deducted from GI, group inventory. So to this, we less unrealized profit of 12,000, and then get the final figure there. Get the final figure. And then from there, we have receivables. Receivables, we do the same. We add those of the parent 247, 100, plus 107, 800. And now to this, we check whether we have any amount of intercompany debt. Now, the amount of intercompany debt, we have this amount of intercompany debt, and we said from the group receivables, what are we going to less? We are going to less 64,000. We are going to less 64,000. So to this, we less what? 64,000. That is the amount of intercompany debt. Get the final figure there. And then from there, what else do we have? We have bank. So for bank, we do the same. We add that of the parent, 21,000 plus 13,800. 800. To this, then we said any cash in transit should be added to this. The cash in transit, we have 30,000. So we add 30,000. 30,000 fair. Yes, get the final figure. And then from there, you'll get the total what? The total assets. So let's proceed and record equity. Let's proceed and record equity. For equity, we start with the ordinary share capital. And basically, we said equity for ordinary share capital, for example, or basically we said equity, we don't add items of equity, those of the parent or those of the subsidiary. Yes, so therefore, for ordinary share capital, we include only that of the parent. Only that of the parent, which is 850. Which is what? 850. But we also have to remember that the parent company here issued some shares to pay the purchase consideration on acquisition of Salama. And the shares which were issued by the parent company were 15,000. And the parent company never accounted for this. So therefore, the ordinary share capital of the parent will be increased with these shares which were issued to pay the purchase consideration. But we say the amount which we add to this should be based on the par value. Remember, the par value per share is 10. So therefore, to the ordinary share capital of the parent, we are going to add the shares which were issued. And this is something we had done in class. You had computed for me this purchase consideration paid through share exchange, and we said to the ordinary share capital we add 150. So you get the final figure there. And then from there, the amount, because you can see when these shares were issued, they were issued at a price of 16. So the amount which is above 10 shillings is a share premium of the parent. The share premium in this case will be equal to the shares issued, 15,000 times the amount which is above is 10 shillings, which is 6. I think that will give us 90,000. That will give us what? 90,000. Okay, so that will be the share premium. And then below that we have something called the retained earnings. Now there are two items I said, I think moving forward, I'll not show you how to compute them because we said even in an exam, we advise the student not to compute these two items. One of it is what? Is the retained earnings, and also something else here, we refer to it as a non-controlling interest. Non-controlling what? Interest. So these two items, don't compute them. We shall not compute them because even in an exam, I advise, and those two items, you cannot compute them because they're too demanding, and most of the cases, you compute those items, you end up getting them wrong. Because basically what we said is that if all these items you are correct, you'll be able to get all the marks despite, or even if you have not computed those two items. So then finally what we need to do is we record now the liabilities. We record the liabilities. The liabilities. We record the liabilities. For liabilities, we start with the non-current liabilities. Non-current liabilities. Non-current liabilities, we have, first of all, the 8% debentures. Remember what you have said is that when preparing this consolidated SOFP, we add similar items of asset and liabilities. What we don't add are only items of equity. So, but all these are items of assets, we add them. And equally, what we have here, these are items of liabilities. We add those of the parent, those of the subsidiary. So for debentures, we add those of the two companies, 460,000 plus what? Plus 40,000. Here, we don't have any consolidation adjustment. We don't have any consolidation adjustment. And then finally, we have current. We have current liabilities. For current liabilities, we have trade payables. Now, trade payables, this is only affected or adjusted with any amount of intercompany debt. Remember here, there is some amount which is to be adjusted to payables. So, but first of all, we add those of the parent for 1,000 plus 167,200. So, and then to this, we say from the group payables, we less what? We less 34. So to this, we less 34,000. We get the final figure there. And finally, we have current tax. Current tax. Current tax, these do not have any adjustment. No adjustment here. So we have an 8,000 plus what? 52,800. No adjustment there. So what you just need to do, you get the final figure there. Get the final figure. Yes, so can you get those final figures? You record them there. Get the final figures as we take a short break. Get the final figures. Record them there as we take a short break.